Welcome to The Explainer. Today, we're jumping into a really cool idea from the Unlucky Investor's Guide to Options Trading that pretty much flips how most people think about investing on its head. It's all about a simple shift. Stop being a player in the market and start being the house. Let's kick things off with this quote from the book's foreword, because it's kind of counterintuitive, right? It suggests that maybe getting crushed by bad luck is the best thing that can happen to an investor. Why? Well, because it forces you to stop just hoping for a win and to start digging into the actual mechanics of the market, the numbers, the probabilities. And that really gets us to the big question here. Just think about the market like it's a giant casino. In that casino, are you the one at the slot machine, pulling the lever and hoping for a lucky spin? Or are you the one who owns the machine, knowing that over the long haul, the odds are stacked in your favor? Let's figure out what that really means. Okay, so first, let's talk about how most people play this game. It's what the book calls the player's game, and it's where pretty much everyone starts out. You're basically just betting on which way the market is going to go. It feels a lot like you're at the roulette table, putting all your chips on red and just hoping.
Yeah, this is the classic move. You buy a stock, you buy an option, and you're making a bet that the price is going to go up or maybe down. It's exactly like playing slots. You're always hoping to hit that massive jackpot. But we all know how that usually goes, right? Those huge payouts are incredibly rare, and all those small little losses along the way, well, they really start to add up.
So if that's the player's game, what's the alternative? How do you actually stop feeding the machine and start owning the casino? Becoming the house is a total mind shift. You completely stop trying to predict the future or guess which way a stock will go. Instead, you position yourself to collect all the small, steady payments from everyone else who's making those big, hopeful bets. You're using long-term statistics to your advantage, knowing that, yeah, you might have to pay out a jackpot once in a while, but the fundamental odds are always on your side.
So how is that even possible in the stock market? Well, it all boils down to this one powerful concept the book calls the fear premium. And this, right here, is the house's hidden edge.
The key is something called implied volatility, or IV for short. You can just think of it as the market's collective anxiety level. It's basically the price of financial insurance. When everybody's scared and worried about huge market swings, the demand for this insurance, which comes in the form of options, skyrockets, and so does its price. Now, here's where it gets really interesting. There's this constant gap between what the market fears will happen and what actually happens. On the left, you see implied volatility. It's that stormy, jagged forecast of all the wild swings the market is bracing for. But on the right, you see the calmer reality, what actually happened. The big takeaway is that the market is a perpetual pessimist. It always expects the worst. And that gap, that predictable difference between fear and reality, that is what creates a statistical edge. You're not trying to be a fortune teller. You're just making a simple bet that tomorrow will probably be less chaotic than everyone is afraid it will be today. And that brings us to this big number, 87%. This is the crucial piece of data that the entire strategy is built on. So what does this 87% mean? It means that between 2016 and 2021, the market's fear gauge, that implied volatility we talked about, was too high. It predicted bigger moves than what actually happened 87% of the time. To put it simply, the market consistently buys way more insurance than it ever actually needs. And this chart just shows you exactly what that looks like in practice. By consistently selling that overpriced fear, using a strategy that basically bets the market will stay within a certain range, traders were profitable 81% of the time. And that's over a 16-year period. Now, it doesn't mean every single trade is a winner, but the long-term statistical tilt is so clear. You're betting that reality will be calmer than the market's collective anxiety. But, of course, there is no free lunch in the market. Being the house sounds amazing, but it also means you're the one on the hook for those rare giant payouts when someone does hit the jackpot. So, how do you deal with that? At its core, the strategy is really straightforward. You just repeatedly sell those overpriced options. Think of it like you're an insurance company, selling policies against big market moves, and you just collect the payments, the premiums, over and over and over again. The whole goal is to let the law of large numbers do the heavy lifting for you. Okay, so this is the crucial trade-off. You have to understand this part. Your returns are going to look like this. You get a very high number of small, consistent wins. But, and this is a huge but, you have to accept the risk of rare but potentially massive losses. This is the jackpot you have to pay out when the market makes a wild, unexpected move that nobody saw coming. And the book doesn't sugarcoat this at all. It's very, very clear that when you sell premium, you are opening yourself up to potentially massive losses. Honestly, surviving these huge, infrequent events is the single most important part of making this strategy work in the long run. Which leaves us with the ultimate question, doesn't it? How do you keep collecting all those steady premiums while making absolutely sure you can survive that rare catastrophic payout when it finally comes? Well, the answer isn't in some magic crystal ball. It's in the boring but essential stuff: smart risk management, proper position sizing, and diversification. And learning how to master that, well, that's a journey for another explainer.